Welcome everyone to this session on diversification and its significance. So, before I begin with the topic, I would like to give you a brief about what's FinSecure's journey as providing assistance to people across various age groups. So, FinSecure was initially started with an aim to, provide financial education for people across various age groups. And the reason why I thought that this is necessary is because I have met different types of people, and wherein I found that they were not compatible when it came to understanding finances, and also there was a lot of confusion when it came to making proper investment decisions. And hence I thought that it could be very helpful for a larger audience if we can actually emphasize on providing financial education. We will be moving on with the session, and this is the agenda which we have set for today's session. Just a couple of instructions I would like to give you before we proceed with the session. If you have any query, any doubt, no matter how complex or how simple that could sound to you, feel free to put that query or that question in the chat box. Towards the end of the session or in between, I will try to address all the questions that you have. Also, there could be certain terms or certain concepts which might sound a bit new for you, sound a bit complicated, but do not be afraid or do not get confused. I will try to give you a gist about each of the new terms or concepts that we'll be covering in the session. Also, in the upcoming webinars, there will be more elaborative discussions or webinars being taken on the concepts that we'll be discussing in today's session. So this is about the agenda. Also, I have this, habit of discussing my personal experiences when it comes to different investment, practices or different types of things that I like to do. So diversification is also one of those which I would, very much like to relate. So as a child, I used to be very fascinated about, traveling to different places. And I am basically a Keralite, and we often go for, this family trips and vacations. So I always used to observe that my mom used to distribute all the cash and the valuables into different baggages. And I, as a child, always used to get confused that why is my mom splitting all the cash into different baggages? Why is she distributing everything? And then, like, I was just wondering, like, why cannot she keep everything in one bag so that it is easy for her to, take that money out for using? So then I go to my dad, I ask him, like, why is mom doing such a thing? So my dad says, like, if out of these three bags, one bag gets stolen, we still have the valuables, safe in the other two bags. So I said, Yari, this is very true. This is very correct. Like even if one bag gets stolen or misplaced, we can still have our valuables, our assets, our cash in two other baggages. So that applies same when it comes to investments. So in investments also, you do not basically park all your savings or all your cash into one particular asset, right? So as a child, my first step towards diversification was to understand that diversification helps you in managing risk, right? So in our investment journey also, we should emphasize on diversifying our savings, our funds equally or as per our allocation into different investment instruments. And that is how we save on, we avoid risk. So I took this as a learning at the very early stage. And then what happened? Few years passed by and I got an opportunity to travel all by myself. So there was a school trip. So I was all ready to go for that trip. And I took that, I remembered that incident wherein my mom used to distribute all the funds into or all the cash into different luggages. So I thought, why not I also do the same thing? And I go a step ahead. So what do I do this time? I distribute the cash into different baggages. But in addition to that, what I do is I distribute it in such a way that in each bag, there are multiple compartments, right? I keep my cash in all those compartments. So my cash is now in lot many compartments in those three bags. So what happens? I end the trip like it was a good trip, and out of the cash that I had taken, there was some money which was left behind. So I'm so happy that okay, there is like I can use that as a pocket money. So what I do is I come back home and then I start searching for the money. And this is when I realize that I am not able to track where did I keep those money in. So this is the mistake that people often do when it comes to diversification. We distribute our assets, we distribute our savings into so many assets that we often tend to forget, or we often tend to lose track where our investments are parked, right? So as a child, I encountered this issue wherein I was not able to track where might have I kept the cash, right? So as we grow old, when we take this decision of diversifying, we should not over diversify. Over diversify obviously leads you to a big disaster, right? You won't be able to keep a track of your investments, and you end up investing into those instruments which you do not understand. So I'll just give you one more example, okay? One more incident which I recently encountered. So one of my student, he had, he was asking me if he can invest into forex. So I was wondering, like this boy who is, just 20 or 21 years old, and he's talking about forex when he doesn't even know how does a proper mutual fund operate, or it doesn't even know, how does the chart function or things like that. So I was just wondering, like, from where did you know about this forex or other type of investments? So he said that he ended up seeing this advertisement on a social media. So you often end up seeing such advertisements on your YouTube ads or other platforms. So like you'll find a person, he ended looks into his mobile and says, I think this particular currency or this particular asset will increase, and then he clicks buy, and then you'll see that the chart going up, and like it's a happy ending. But in reality, that is not the case. If you are not able to understand an asset, you should not enter into that. Now, the whole idea about investing is to get better returns, right? But what are the factors that help you in giving you better portfolio returns? So basically, there are three important factors that we have to look into. The first one is market timing, second, security selection, and the third one, asset allocation. So what is market timing? Basically, that is something, wherein you are trying to determine which stock will go high at a particular time interval, or which asset will be at the peak at a particular time frame. Basically, no one will be able to time it correctly, right? There could be a certain set of people who will be effectively able to do that, but this is not something which everyone can do. This is only something which few people can do. I'll give a very straightforward example. In the previous year, when COVID, was being spread across our whole globe, our equity markets, that is stock market, had crashed from its high of 12,000. It came down to 6,000. There were a lot of people hesitant to enter into the stock market, thinking that it will go even more down because there is a lot of uncertainty in the economy. There is this pandemic situation, going on around, like cases are increasing day after day. But today, from that level of 7,000, it is at 14,500. So if you think rationally, or if you think logically, the market should not be rising, right? Like it should be either stagnant or it should be going in the opposite trend. But that's not the case. And that is how all the assets behave. When we try to time any assets, or when we try to time the market, it often does not work away. So timing of the market should not be done by, if you're not able to do that, then you should not be doing that. The second is security selection. So what is security selection? Now, let us say that as part of investments, you have identified to invest in stock market, for example. So what you do is you open your demat account and you invest into some companies. In this, you have to identify good security. So what is security? Over here, it is company. You have to identify the good companies in which you can invest. Here again is a second dilemma. all the people are not able to determine if one particular stock will perform well, right? They do not have that conviction. They often get confused. Like if I enter in this particular stock, will it go up or will it go down? So this confusion always is there in their mind. So hence, this is something which only some people can do. So what is that one thing which everyone can do? And that is asset allocation. So why is this that everyone can do? Because let's say that you are familiar in understanding mutual funds, for example, or you are familiar in understanding stock market. So you create your portfolio in such a way wherein you are allocating certain amount of money into that particular instrument. And without much research on the other asset classes, you can distribute, let's say, 20% of your investments into debt funds, 20% of your investments into gold fund. And when you do such a thing, you don't have to, research on each of those assets extensively. You have to just understand how does it function. And if you feel that you can track these assets, then yes, you can enter into it. So moving forward, we will focus on diversification in today's session. So diversification itself has got different categories, right? So we have diversification across various asset classes, which is very commonly known. We have diversification across various time horizons. So like I was telling you about market cycles, some people diversify based on the market cycles. Like if a person feels, okay, this particular year would be better for equity, stock markets, then they will try to allocate more money into that particular direction. But this is something not everyone does, so I will not be emphasizing more on time horizon diversification. The third and one of the most important types of diversification is across various age groups. So why I have taken this topic in specific is because uh, the way a 25-year-old invests his or her money is different than a way a 50-year-old will do, right? As you grow old, you should not be taking too much risk, like your responsibilities increase. There are a lot of periphery expenses that come into play, so you should not be taking too many risks. So we'll be discussing on this front as well, like as based on different age groups, how you should diversify effectively. So for today's asset class discussion, I have identified these five assets on which we will discuss. The first one is equity, that is stocks. The second is gold. Third one, fixed deposit or other fixed income kind of a thing. Fourth one is real estate, and the fifth one is retirement funds. So moving to equity. So equity means nothing but stock market, right? Like you have this image of Bombay Stock Exchange being seen over here. So that is nothing but participating in the stock market. Now there are two ways in which you can participate in the stock market. One is by directly purchasing shares of a company. That is by opening a demat account with a broker and then investing your money directly into those particular companies. The other one is indirect purchase. So what is indirect purchase? That is through the route of mutual funds. So here what the mutual fund companies do, they invest on your behalf. So your fund is basically invested through them. And that is considered to be a much more safer way of investing in equity rather than directly investing in stock market. So just to give you, more understanding on equity, we will be having another webinar. Moving forward, the next asset class which I identified is gold. Now, gold is considered to be a very commonly known, a very traditional form of investing for many people, especially in India. But there are like different ways to invest in gold. So over here, you can see that I have mentioned gold as a physical asset, right? You can buy physically and you can buy gold as an ETF. So what is this ETF? That is nothing but exchange traded fund. I'll try to simplify this term. So normally when you buy gold, there are some periphery additional charges that you have to pay. For example, you have to pay up making charges, right? You have to end up paying GST. You have to pay some other tax. So those are extra expenses, or those are like extra that you have to pay to buy that particular asset. Later on, there was something called as gold ETFs which were introduced into the market. So what is gold ETF? you are basically buying gold in a paper format. Like you are not physically buying gold, but you are basically buying that asset, right? And your investments is directly proportional to how the gold rates fluctuate. So this is a form of investment which is good. Like gold ETFs is a good form of investment, wherein you can participate also in the gold market. At the same time, you can reduce your other periphery expenses. So this is about gold. Again, we will be having a webinar discussing more about gold ETFs and how to understand which ETFs perform better than the rest. The third one is real estate. Now, this is something which is very confusing for many people. Like people often say, like there are some set of people saying that you should buy a property, and there are some set of people saying that you should rent out a property. If you go 20 years down the line, then yes, like if there was a flat being bought at 10 lakhs rupees and now it will be like 1 crore, that is like 10 times returns. But that is not the case, which is prevalent now. In the last 5 years, the real estate market has been impacted, right? And also, buying a property is not that easy. Like you won't be like if you want to start off with a mutual fund, you can start off with 500 rupees in the beginning. But to buy a property, you cannot do that, right? So there came into this new concept called as REITs. So over here you can see, right, real estate investment trust. Now this is a newly introduced concept in India. In the US, this is commonly used, but then in India, this is a new concept. So what is REITs basically? So in the REITs, you can participate as the way you participate in your mutual fund. So it is like in small quantities you can, invest your money into REITs, and that is more easy for a retail investor, for a small investor. Again, on REITs, so REITs itself is a vast topic, so we can have more discussion on REITs and also InvITs. InvITs, it's nothing but infrastructure investment trust. So we can discuss more extensively on these two assets, maybe in the next webinar. So moving forward, the fourth type of asset what I kind of identified as fixed income sources. Fixed deposit, recurring deposits. Now, these are the favorite forms of investing still for many people in India. Now, why this? The primary reason why people still invest in fixed deposit and recurring deposit is because one, they do not know about other investment options. Second, they want their investments to be secure. And third, they want liquidity, right? But if we are just considering liquidity and security, then there are other options as well as compared to fixed deposits and recurring deposits. And one such option is debt funds. So what is debt funds basically? So debt is equal to loan, right? Debt is nothing but loan. So what debt funds do is there's a pool of funds that is being formed, and this fund gives a loan to maybe government, or maybe a corporate company, or maybe to a different entity, against which they get a particular percentage in return. So that is how debt funds operate. So again, in debt funds also there is a lot of categorizations which are there, and that also we will discuss. The primary reason why I included debt funds over here is fixed deposit and recurring deposit should be replaced with debt funds if you are focusing on having a secured and liquid portfolio, like liquid form of investment. The fifth option is retirement funds. One is National Pension Scheme and the other one is Public Provident Fund. National Pension Scheme is one of my favorite forms of investments. Why? Number one, it invests in equity markets. So the possibility of getting better returns is way high as compared to a Public Provident Fund. Second, NPS, that is National Pension Scheme, is a pure retirement fund. Now, why am I saying it is a pure retirement fund? Because you cannot redeem your investments till the age of 60, right? Yeah, it's a different case. Like some people might have that dream of retiring at the age of 40, but on an average, people retire at the age of 60, and hence this fund was introduced. This scheme was introduced, National Pension Scheme, wherein your investments are blocked till the age of 60. Now, how is this beneficial for you? Let us assume that you are investing into a mutual fund. So I had recent queries from few of the people. So they were asking me which mutual fund should I invest in. So I told them that you can invest in this mutual fund. And the next question that they asked me is, can I withdraw my funds within a year? So I am thinking like, why do you want to withdraw your money in the first year? So in that case, you better not invest only, right? Like if your sole purpose is to withdraw your investment at a very early stage, then you better not do it, right? But they can still do it when it comes to mutual fund. But when it comes to NPS, you do not have that provision of removing your funds at the early stage. So this actually is like a blessing in the long run. Like your compounding happens in such an amazing way that at the age of 60 you will find, okay, now this has actually worked wonders for me. So that is all about retirement funds. So I'll just take a small break over here. Does anyone have any doubt on the topics that are covered till now? Okay, I take that for a no. But if at all you have any doubt, then please feel free to drop query on the chat box. In between, I'll be checking those messages in the chat box. So this particular slide, which you can see in front of you, the title is Asset Allocation Cult. So this article is released by Mint Research every year. So they give this performance review of each of the assets in various time frames. So I have taken this for the last 10 years. So let's just take a look. How did assets perform in the last 10 years? Yeah, you can see that there are like a lot of assets which are being listed out over here. We will not be discussing on all these assets. We will just focus on large cap funds, real estate, and gold. These three categories we will discuss. So first, let's talk about large cap. So if you see the large cap, or rather the stock market, I would fondly call it as, has performed in a very roller coaster kind of a way. Like if you see in the year 2011, it was at negative 24.64%. Suddenly in the year 2012, it is positive 25.70%. So you can basically understand, right? Like how extreme can stock market go? Like 1 year it is almost negative almost negative 25%, and the very next year it is positive 25%, right? So it can be very volatile, and this can give you minor attacks also. So this is a clear indication that you should not be just putting your money into stock market entirely. There should be a proper balance when it comes to investments. So next we will focus on the next asset, which is gold. So if you see, I just told you that in the year 2011 stocks performed, that large cap stocks performed negative 24%. In the same year, gold performed positive 29%, right? What does it indicate? It clearly indicates that if you would have your asset allocated evenly in these two assets, then you wouldn't have made losses, right? Your portfolio wouldn't have been red. If an individual allocates entirely into one particular asset, yes, the possibility of that being negative is more high as compared to allocation into different assets. Same we can see with real estate. But in gold again, like gold is also not something which is safe throughout. Like if you see, gold had performed exceptionally well in the year 2011, but if you see in the year 2013, it went to negative 18%, right? So it's not that gold will always give you better returns, but when gold was performing negatively, you can see that large cap companies and real estate was performing better, right? So that is all about the market cycles. You cannot determine which particular asset will perform well in that particular year. But if you have your bucket of instruments in such a way that all the investments are done properly, then you can have a sound sleep, right? Like you won't have to worry if the market falls. You don't have to worry if the gold prices go down. Like you are in a balanced situation. Like, and that is your whole purpose about investing, right? Like, yes, you need good returns. All that is accepted. But in the end of the day, you should be having a sound sleep, right? And in order to have a sound sleep, investing into different assets is very important. So this is the just about the article which Mint had given us. Moving forward, I have just consolidated all of this into different horizons. So if you could see, in the last 5 years, equity had performed 12.6%, gold had performed exceptionally well with 14%, right? Now let's quickly come to the other data, which is the performance in last 10 years. So in the last 10 years, what happens is equity is at 9.8% and gold has reduced to 8.7%, right? So this is what I'm talking about. You should not basically try to time any particular asset. It keeps on going up and down. Like for example, if you are considering the historical returns of the gold's return, then you might have the tendency to allocate more money into the gold class, right? But maybe that won't work for you in the the way you think it will. So you should not basically keep on changing your asset allocation every year. No, you should just give your portfolio to have some breathing space, give it some time so that it can grow in a considerable amount of years. So this data I had uh, collected this data with the help of Mint Research, Paisa Bazaar, and Economic Times. And this is how we figured out this data. And moving forward, so this was all about the type of diversification that you can do when it comes to various asset classes. Moving forward, how we can diversify across various age groups, right? So we have this guy who is 25 years old, right? So he begins his investment journey and he allocates 60% into equity, both direct and indirect exposure combined. He allocates 60%. Uh, and he also allocates 20% of it into NPS. So of which I am, considering that out of the 20%, 10% is being invested in equity because NPS, like I told in the previous slide, NPS also invest a certain amount of it into equities, right? So this individual who is 25 years old has an allocation of 70% towards equity, 10% in the remaining NPS scheme, and those 10% are nothing but comprising of debt funds, which are, like I told you before, are secure funds, and the other 20% into gold ETFs. So his portfolio is in such a way that he has a risk appetite to invest into the equity, and he has considered 70% as an allocation, which is good because at the early age you can bear to have that kind of exposure towards the equity market. He has also invested in gold and debt, which helps him maintaining that balance if something goes wrong. So this individual grows old, he turns 40 years old, and now he has to rebalance his portfolio. Now, why is rebalancing of the portfolio important? So from the age of 25 to 40, that is a time frame of 15 years. 15 years is well enough for your equity to increase 5 times, 6 times, 7 times. So when your investments in equity have reached, that many times, it is quite logical that you should partly book some profits and invest that amount into a more safer asset, right? So what should a 40-year-old do? So basically, the earlier exposure was 60% in equity. He booked 20% of it, invested that 10% into gold ETF, and the other 10% into NPS. So basically, he's trying to increase his allocation into much more safer assets. And this is very important because as you turn 40 years old, your responsibilities keep increasing, your periphery expenses start increasing. And you should have that sense of assurity. Okay, my investments are safe. And this is how you rebalance when you come to the age of 40. And then you gradually, grow old and then you reach the age of 60. Now, this is an age wherein people do not want any headache when it comes to investments. Like they don't want any confusions or any complications with the investment perspective. And also at this age, your NPS, if at all you must have invested. So we had this individual investing 30% of his investments into NPS, right? So after he got retired, then he invested, then that NPS got matured, and then he invested into the debt funds. So over here, you can see that the equity exposure is 20%. I have still given it 20% because there could be some individuals who would still want to participate in the stock market directly or indirectly. But as good practice, maybe you can have zero exposure in the equity markets and you can allocate more percentage into your debt funds and the gold ETFs. Now, the reason why I specifically took this, topic of 60 years and 40 years. Now, I totally understand that the crowd for today's session is, maybe in the early 30s or late 20s. But I specifically took this topic is because there would be other individuals at your, at your home, many family members, whom you can suggest. Like, okay, if you are, 40 years old, if you are 60 old, then maybe this is how you should allocate your funds. This is how you should distribute your investments. So this is something which you can, take it forward with your family as well, right? So moving forward, now let us try to just summarize. Can you just let us try to summarize on why diversification is important? Number one, in the very first beginning, we learned that diversification helps you in managing risk. Very important. The moment you minimize your losses, that is when your profits grow, right? So you should always focus on minimizing your losses, right? You should always see to it that your profits keep increasing. Second is maintaining a healthy portfolio. So, like we saw in the asset allocation guild, wherein the large cap funds and the gold, you were having this roller coaster ride. So, if you are diversifying effectively, then yes, you will be able to have a healthy portfolio, right? The third one is not to worry about the market cycles. Like you should not be, trying to time the market. You will not have to time the market if you are basically diversifying your investments. And the fourth, which I have not mentioned over here, is peace of mind. Like if you're diversifying your investments, then you can have a good sleep even if the market falls 10% the next morning. Like, that's the best part about diversification. So here I'll just give you my experience as an investor that so when I began my investment journey in my early 20s, like I was like 20 21 years old, and my first step towards investment was mutual funds. So I was very fascinated about the fact of equity markets, but then I did not want to directly participate into the stock market. So I began my mutual fund 6 months down the line, and I think, no, okay, now I am ready to invest into stock markets directly, right? So I began my journey by directly investing into stock market as well. 6 months are done. Amazing. Like I can see only red in my portfolio. I'll say that again. I can see only red in my direct investments into equity. But at the end of the year, I was still in profit. Why? I could see that my portfolio was better because I had allocated in mutual funds as well, right? So in the future, or if you want to explore some new investment instruments, you are free to do so, but just see to it that you have your other investments parked properly, right? So that is also something that you should take ahead when you are considering. Now, considering all the concepts or all the discussions that we had till now, we will just try to figure out a real-time scenario. But let me just okay. So we have few questions over here. I'll just take a moment to address these questions. Okay, so kindly brief about the tax on withdrawal. So I believe you are you hinting on the taxation of which particular scheme are you hinting at? Can you please be a bit specific on that? The second one is what are the important fund analysis factor? Yes, so we can have an extensive session on fund analysis also. So we'll be having a webinar on understanding mutual funds in a better way. So in that webinar, I will be obviously covering these points as to how should you analyze your mutual funds and how you can track the performance of that particular fund in an effective manner. Okay, we have one more question. Can you please let us know if this tax, if these investments can give us tax? Yes, absolutely. There are many investment instruments which can give you tax exemptions. One of my favorite forms of investments is national pension scheme. So national pension scheme gives you tax exemption. It gives you better returns, lot of benefits on that front. So yes, we will discuss more in detail about tax exemptions also maybe in the next webinar. So I'm repetitively saying next webinar, right? So I am basically planning to continue my association with TradeSmart or maybe with other people also. So this will be kind of a masterclass series wherein I will be focusing on providing the basics of different assets of different types of instruments. So we can have more elaborative sessions on discussing on NPS, discussing on various tax instruments. We can have discussions on mutual funds and things like that. Okay, we have what the tax to be paid in short-term withdrawal and also long-term withdrawal. Okay, so this is a good question. So tax, when it comes to taxation, it is a very tricky. There are basically two types of taxations when it comes to investments. One is STCG tax, that is short-term capital gains tax, and the other one is LTCG, long-term capital gains tax. So these two parameters are different. When you fall under the bracket of LTCG, your taxation is directly proportional to the your income. That is based on your income slab. When it comes to STCG, it is directly taxed at 15% and 4% cess. So that is total of 19%. I hope that clears it out, right? Okay, so moving forward, considering all the concepts that we have, I've tried to identify three individuals of the similar age group. First individual, we have Mr. Amar. So at the age of 25, he begins his investment journey. What he does, he consults everybody, and then maybe he comes up to a conclusion that I will invest 70% of my savings into fixed deposits, right? Like he does that. Why? Because he does not know about other instruments. He ends up doing that. He invests 70% of his savings into fixed deposits. And then he thinks, I need something for my retirement also. How about public provident fund? And then he thinks, okay, postal savings scheme is also something which my dad and my grandfather had done, and they got good returns. So he does that as well. So what does he do? He allocates 70% into FD, 15% into PPF, and 15% into postal savings scheme. So this was the way how Amar invested his savings. Next, we have Miss Ravina. Ravina. Yeah, so here we have Miss Ravina. So Ravina again wants to start her investment journey. Then she consults few of her friends. She is asking, tell me some good investment options. Like I have heard of FD and RD, but I don't think so. There is any point in investing in FD and RD. I mean, like there is inflation of 6%. Your FD will give you 6.5%, and if I try to balance it, then I'm just making zero point 0.5 or 1%. So what is the point in investing in FD? I tell her, yes, Ravina, you are absolutely right. You are smart enough to understand this factor. And then Ravina tells me, I will invest in stock market because it gives, amazing returns. Then I tell Ravina, yes, Ravina, you can absolutely invest in stock markets. But when you are investing in stock markets, you have to understand that it is risky also, right? Like sometimes you make profit, sometimes you make loss. So now Ravina is thinking again, okay, yaar, like now what should I do? Should I be investing into stock market? Then I tell Ravina, don't worry. Now, since you're just 25 years old, maybe you can have some exposure into direct form of investing into stock market, and you can allocate 30% into mutual funds. So that way you will have your portfolio balanced also if you're investing in equity. Then she said, yes, this is absolutely right. I can do this. So what happens? She ends up allocating 50% into equity by direct form and indirect form. Then she tells me that she wants to invest in a retirement fund. I tell her that go for NPS, but she is like, "Arey yaar, I want to retire at the age of 40. NPS will give me good returns. Like NPS, I can withdraw only after the age of 60. What should I do for the next 20 years? I'm not investing in NPS. I'll invest in PPF." I said, your choice. Go ahead. She invests 20% into PPF. And then she says that, okay, in the coming few years, I also want to get married. Like I need some gold also with me. So, and like, then she was like, should I buy gold? So I to tell her the reason why you are planning to buy gold is so that you can buy it at a lower price as compared to the next 5 years, right? So why not do it through ETF? She said that yeah, this is a good option. I'll try investing through ETF, and then she allocates 30% of her savings in ETF. So this was the investment portfolio which Ravina planned. Next we have Nikhil. Nikhil, like so many segregations, right? So Nikhil is that the risk taking guy. So he's like, I want to invest in equity. I want to invest in stock market. Like I tell him, yeah, like it's good to have such ambition. It's good to have a direct exposure in equity. But then like just think again, and maybe you can have a 50-50% allocation rather than a 60-40% allocation. So he said, okay, that sounds good. So I'll have 30% direct exposure in equity and 30% indirect exposure through mutual funds. I said, yeah, that is good. You can go ahead. And then he tells me, I also want to start with a retirement fund. So I tell him that, okay, yeah, you can start it. You can begin with NPS. So even he was a bit hesitant, like why NPS? Like I'll have to wait till the age of 60. Like it does not help me. I tell him like, you can go for NPS because it also allocates some amount of it into equity. So the moment he heard equity, he was like happy, okay, I'll do this. And then he said that I also wanted to invest in real estate. So I told him that real estate is not performing that well. But then if you want to give it a shot, maybe you can invest through REIT. So like we, discussed before, REITs is nothing but some a form of instrument wherein you can participate in a small way. Third, and the final one is gold. So he also wanted some exposure into the gold. So this is how he allocated his investments. Years passed by, and then they all these three individuals invested in this fashion. And then uh, I made a kind of a comparison chart wherein how did their investments perform. So this is something which just make a note of it very, 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 very. Just let me do. Yeah. So if you can see over here, we have Amar who had allocated 70% into his FD, 15% into his PPF, and 15% in his postal savings scheme. I have considered that all three individuals at the age of 25 had invested 1 lakh rupees lump sum. They did not add any new funds into that investment. So for Amar, it grew to be 1,41,000. For Ravina, it grew to be 1,83,000. And for Nikhil, it grew to be 1,77,000, right? This I have considered, uh, like you can see, like at the bottom, I have mentioned the performance of last 5 years. How did these perform? This is actual data which we discussed in the previous slide when I was showing you how did the assets perform in the last 5 years and the last 10 years, right? So this I have fetched from there, and this is how it performed, and this is how their portfolio looks after 5 years, right? So in this comparison chart, you will clearly understand that Ravina is a clear winner, right? Ravina ended up getting 83% in the span of 5 years, right? Like she has beaten Nikhil and obviously Amar. Like Amar was not in the competition only in the first place, but she was able to beat Nikhil even after the fact that Nikhil had allocated more funds into equity. But now let's take a comparison of 10 years. So what happened in the next 5 years? Uh, like it's getting slow. Huh. So in the next 10, like in the 10 years, the situation changes slightly, right? Here Amar is still third, but the position has been swapped between Nikhil and Ravina. Here we have Nikhil at 2,83,000 and Ravina at 2,63,000. Using this comparison, I am not trying to emphasize that Nikhil performed well because he had allocated more money into the equity asset. What I am trying to emphasize is that you as an investor should not compare your fund's performance with somebody else, right? If Nikhil would have compared his investment with Ravina after 5 years, then he would have thought, okay, I need to have more allocation in gold. Then his fund would have not performed the way it is performing now, right? So it is the core principle. when you are allocating your funds, allocate it in such a way that you are able to understand where you are investing your funds, right? So this is very crucial when it comes to investments or when it comes to asset distribution. So this is how I want to end today's topic. And I hope that most of you all have understood the concept behind diversifying your funds. And this small, comparison of three different individuals must have given you more clarity on investments, right? So, do you have any more questions? If you have any more questions, then you can just keep, posting it on the chat window. I will address each of those. I think there is one more question being raised by. Okay, so we have one query by, okay, what was the assumed rate of return in comparison? So if you check the slide in which I had given you the consolidated returns for the 5 years and for the 10 years, I have considered those same, and those are the actual datas which we try to aggregate using various research companies and various articles. So that is how, and I'm not sure if you are able to see it, like, but at the bottom of the slide, I have mentioned equity is at 9.8%, gold at 8.7%, and things like that. I'll be sharing this deck with all of you all who have participated. Maybe you can use this for your further reference. Yeah, so that's with that. And what is okay? We have, does Finscure have any investment medium or portal? So Finscure does not have any investment portal at the moment, but yes, we are planning to have something on that direction as well. Maybe if everything goes well, then we can have something on that front also. Are there different mutual funds for long-term and short-term horizons? So this particular question, I will cover this extensively when we'll be having that session on understanding mutual funds, right? So we can discuss more in detail about that. So that's it from my end, guys. Have a great day. Have a wonderful Sunday. Thank you.